At this moment, all participants are in listen-only mode. Later, we will conduct a question and answer session. At that time, you may click on the raise hand icon to ask a live question. Please note that this conference is being recorded. I now hand the conference over to Mr. G. Shivakumar, CFO at the Great Eastern Shipping Company Limited, to start the proceedings. Thank you, and over to you, sir.
Thank you, Aman. Good afternoon, everyone, and welcome to the results conference call for Great Eastern Shipping. Thank you for being here. Let me first take you through the highlights of the results. We also have Mr. Bharat Sheth, our Managing Director and Deputy Chairman, with us, and we will be happy to take questions after the presentation. So let's first run through the presentation. So standard disclaimers: market is volatile, and we don't know how it's going to pan out. We can give you some views on how the fundamentals are stacking up, but we don't really know how markets can pan out. First, let's look at the P&L, and we are looking at the reported financial highlights. We had declared earlier an interim dividend of 4.5 rupees per share. We have now declared, the board has now declared another interim dividend of 5 rupees 40 paisa per share, taking the total dividend declared to 9 rupees 90 paisa per share for FY22. On a reported basis, and again, these are the reported numbers. Those who have been attended these calls in the past know that we also discuss something called normalized numbers, which we believe give a better picture of how the business is doing. So we have a drop in consolidated profit from 919 crores to 630 crores. The normalized drop is not as much, but we'll come to that in a bit. And on a standalone basis, we've dropped from 1,030 crores to 812 crores PAT. But the important thing to focus on always in our business, and the one special characteristic of our business, is that it produces a very strong cash flows. So let's look at what has happened with the cash flows during the year and how we've used these. And we've tried to put together a short, simple explanation for what we've done with the cash flows to give you an idea of how much cash is generated. So we're looking at about $140 million of cash generated in the business, of which just under $50 million, and I've looked at all the numbers in dollars because our business is basically in dollars. So about $50 million in net capex. This is ships that we bought, dry docks that we did, and equipment that we fitted onto our ships, retrofitted, minus the sale proceeds from the ships that we sold during the year. That's $48 million of new investment in new capacity, effectively. We've reduced our debt by $62 million, the gross debt, during the year. Again, freeing up borrowing capacity for the future. We've also done 2 returns to shareholders, one in the form of dividends. This includes the final dividend of FY21 and the first interim of FY22, which were paid out during FY22. That's $26 million, about just under 100 crore rupees. And last we, up to 31st March, we had spent about 163 crores, equivalent to about $22 million on the buyback. This is including the buyback tax that we paid. After all this, we drew down cash to the extent of between $10 and $15 million. This is, I should have clarified, these are standalone cash flows. We have drawn down our standalone cash balances by between $10 and $15 million during the year. After having accomplished all this, which you can see that this is about $150 million of uses of cash. Coming to the normalized results, this is the explanation for the normalized results. Basically, we are stripping out the impact of foreign currency revaluation on loans and current assets and liabilities, which are point-to-point impacts. We have also taken out the impact of the derivatives gains or losses. These derivatives are on our borrowings, which are in rupees and have been swapped into dollars, and effectively should be treated as dollar loans. So on a normalized basis, the difference in performance between last year and this year is not as stark. So you'll see in the standalone results have dropped from 842 to 787 crores. So a drop of only about 55 crore rupees. And even on a consolidated basis, the drop is only about 80 crore rupees between last year and this year, FY21 and FY22. Now, what drove these results? And the net asset value, and this has been a big impact. In March 21, the NAV per share was 489 rupees on a standalone basis. This has gone up very significantly during the year to 618 rupees per share. And we'll come to how it's grown later on in the presentation. On a consolidated basis also, it has gone up. There's not much impact on the offshore business, in the offshore side of things, on the NAV. So it has gone up similar to what it's gone up on the standalone NAV movement. Looking at the performance, the business performance during the year, you can see that crude tankers and product tankers had a terrible year, probably the worst year in 3 decades. And therefore, earnings, you can see the crude tankers our crude tankers on average earned about $13,000 per day less than in the previous year. That's a 50% drop in the rates. And product tankers had a 1/3 drop in the rates. LPG carriers, which tend to be on time charter, our LPG carriers tend to be on time charter. In any case, the market was sort of similar to where it was in the previous year. So not much change. Dry bulk has been the highlight for this year. $10,900 on average has gone to $26,900. This, despite crude and product carriers forming 60% of our fleet and dry bulk forming only about 30% of our fleet. This outperformance by dry bulk has cancelled out the underperformance by the product and crude tankers, and that's why we've produced almost a similar result to the previous year. This again sort of underlies the logic in our being in these different sectors, because they are able to smooth out the earning cycles while also offering opportunities for investment at different points in their cycles. Just looking at what happened in Q4 versus Q3, crude tankers picked up a little bit towards the end of Q4 after the Russia-Ukraine conflict started in end of February. So we had slightly stronger earnings. Product tankers were more or less the same as they were in Q3, maybe marginally lower. LPG, of course, are on time charter. And dry bulk was significantly lower than it was in Q3. Of course, the first quarter of the calendar year or Q4 of the financial year is traditionally a very weak period for the dry bulk market. So this is sort of expected. I mentioned the change in the net asset value, the standalone net asset value. Now let's see what went into it. So you started at 489 in March 21. The cash profit, which is PAT plus depreciation, and these are rough numbers that I'm talking about. The PAT plus depreciation is about 85 rupees per share. So that's built up because that is cash in the bank when the PAT plus depreciation, actual cash flows. The fleet value has gone up during the year. So by about $100 million, which when you divide by a number of shares, etc., works out to about 52 rupees per share. Then you have a dividend payout. So we paid out 13.5 rupees as dividend between the final dividend of FY21 and the first interim of FY22. So that's a negative to the net asset value because it's gone out from the cash balance. And the buyback has contributed about 6 rupees per share to the net asset value. Basically, we bought back about 42 lakh shares at a discount to the net asset value, which adds value to the remaining shareholders by improving their net asset value because we bought back almost 3% of the equity at a significant discount. And that's how we've reached this NAV of 618 in March 22. I want to highlight here that a very significant portion of this increase is that 85 rupees, which is cash profit, which is actual cash accrual, which has happened from the business. Just as an update on the buyback, as I mentioned, we up to date we've bought back just under 42 lakh shares at an average price of 316.21. We utilized about 133 crores in this, which is just under 3% of the equity. We had to pay tax on this buyback, which is about 30 crores. And so the remaining amount, which is we had allocated and taken a board approval for a total buyback of 225 crores, of which we have spent only 132.79. So we have a remaining amount of 92.21 crores of buyback approvals, and for which we have 2 months more. Our buyback opened on 7th of January 2022. So we have up to July, early July, in which we have to execute the buyback. The maximum price, just in case you need reminding, was 333 rupees per share. Coming to fleet supply, we have, and we reiterate this, we are at one of the lowest order book to fleet ratios. It's at 6.6% for dry bulk, 5% in product tankers. These are historically low order book numbers. And we have mentioned several times in the past, this gives us hope for the future because the supply, potential supply, is limited. Again, the order books are full all the way up, probably up to end of 24. You may get one slot here and there in 24 itself, but even that would be very rare and it would be very expensive. So it's unlikely that this is going to significantly change for the next 2.5 years. Asset prices have been high, and so they were already up for tankers, which are the top two graphs, and in recent times they've gone up a little bit more, and so significantly above the levels at which a lot of these assets are significantly above the levels at which we are, which is our comfort level for purchase. But let's see if we get opportunities. Dry bulk, again, because of the markets being very strong, the prices have gone up 40-50% in the last year and a half. While LPG continue to be strong, they hit the bottom 3.5 years ago, and continue to be pretty strong. Scrapping has been low because of what markets have been doing. Crude tankers and product tankers have seen some scrapping, but still not much. For the whole quarter, it's only less than 0.5% of scrapping. This is, again, possibly because of optimism. Those scrap prices have been very high and again, hitting historically high levels. Dry bulk has been very little, and which is understandable because rates are so firm that there is no real incentive to scrap the ship. You might as well run the ship. If you have to spend money to do a dry dock and extend the life, you can do it because the rates justify it. Coming to the oilfield services business, this is again the same chart that we look at. There's a large proportion of the fleet which is very old. There are lots of cold stacked rigs which may not come back. So 50 rigs have been cold stacked for more than 3 years. And these rigs will find it difficult to come back without spending a lot of money to reactivate them. Similarly, for offshore supply vessels as well, we have quite a few which have been cold stacked for significant amounts of time. One thing which is happening is that there has been a gradual improvement in utilizations. We are now getting close to the 70% utilization level, which is the highest we have been for a significant period of time. Just before COVID struck, we were at these numbers, almost at these numbers, and then it went down significantly again. But now we have crossed those levels. There is a little bit of excitement and activity in the market. We haven't seen significant price changes in recent tenders for rigs. However, there is certainly more activity from the oil companies, especially in the Middle East, for taking in more rigs on contract. They seem to be increasing their level of activity. So these are new requirements which are coming in. From our point of view, that's Great Ships' point of view, the next rig pricing is in H1 of FY24. So that's this time next year, where our rig comes off contract. We have a rig which has come off contract now, which will be coming off contract anytime in the next couple of months. She has already got her next contract for 3 months after this one. So the next pricing actually we have to worry about in rigs is 12 months from now, which hopefully should get done by the end of this calendar year. In vessels, we have 4 vessels which are to be repriced in H1 FY23, that is before September, and 2 vessels in the second half of FY23. In recent times, and people who have been following us for some time will know that when the crisis hit and utilizations went down in international markets, we used to operate about 25-30% of our fleet internationally. This is a vessel fleet. We brought most of them back into India because we were getting contracts in India. This was one market which was, while the rates were not very lucrative, at least we were getting utilization. So we brought most of our vessels back into India. Recently, we took one vessel out into the West African market because international markets are beginning to look up, pricing is beginning to look up, and we might look at taking out 1 or 2 other vessels as well. One thing we do see is that the level of activity and inquiries for especially the larger, more specialized vessels is quite strong. Just a couple of slides on, these are standard slides showing how we went up the leverage curve between 2016 and FY16 and FY19, and how we've come back down. Again, this gives us a lot of headroom for expansion, and we'll have to see whether we get those opportunities for expansion. This is what has happened to our consolidated net asset value over the years. So we were at about 450 rupees per share. In FY16 and 17, actually the 450 rupees was sort of a holding number because we were not able to get valuations for our offshore assets because the market was really broken. But we went down to about 400 rupees per share in FY18.
I'm getting no audio at all, yeah. They're useless.
Hello?
Yes, Shivakumar sir. Please go ahead. I'm sorry, that was on the line of Bharat sir. Muted.
So we have, so the consolidated NAV has gone up from 400 rupees per share over the last 4 years. So this is from March 18 to March 22. It's gone up to 679 rupees per share. Just to reiterate before we close the presentation, we are disciplined buyers. We look to buy only where we can see value. We don't see a value in growth for growth's sake. We are careful with our investments, and we'd like to ensure that any capex that we do results in a good return, which is past our hurdle. We will also have low balance sheet leverage, which will enable us to run a large proportion of our fleet on the spot market and do time charters only on an opportunistic basis. We have back tested these. We are aware that having a strategy of being very disciplined in our price levels could result in large cash holdings for significant periods of time. However, we have back tested this. We have back tested both the purchase model that we follow and the spot versus time model that we follow over the past 10-15 years, and found that this is the model that gives best results, and that is what we will be following. So we found that even holding cash, the cash drag over 2-3 years from holding excessive cash is usually compensated by the drop in the value of the assets and the ability to buy the ships cheaper. So with that, I come to the end of the presentation, and we are happy to take questions from you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. To ask a question, please click on the raise hand icon available on the toolbar, or you may click on the Q&A icon to raise hand or type your question. The operator will announce your name when it is your turn to ask a question. Please accept the prompt on your screen and unmute your microphone while proceeding with your question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Himanshu Upadhyay from O3 Capital. Please go ahead.
Hello, am I audible?
Yes,
sir, you're audible. Please go ahead.
Yeah, so my first question was on offshore, okay. In last few years, we have seen a number of consolidation deals, okay, Noble and Maersk, Tidewater and Gulfmark, Ensco and Rowan, etc. What impact and opportunities do you see of it in the next few years? And in last call, we had stated, or previously also we have stated that we want to look at some stability in that market and improvement in offshore business before doing anything on that side. So what is your current reading and how are you looking at the market for opportunities?
Yeah, I don't know about the merger. Hopefully the mergers will help to improve pricing as you get less players. Again, but even if these are leading to improvements in international pricings, what happens in our market may sometimes be may sometimes not follow the international pricing. We hope it will, but in any case, the market seems to be, at least the slack seems to be getting taken up. And we've been hearing of Saudi Aramco and ADNOC looking for rigs, several rigs, and reports are of maybe 20 to 30 rigs additional requirement, which hopefully will reduce the oversupply of rigs in the market.
And one thing, we are reading that the price of offshore vessels and rigs is increasing with rates also steadily improving. Any rough estimate what would have been the increase in ask price for a jackup rig which is 10 years old from the bottom, means the what we are owning?
So we've seen, okay, one thing which has happened is that we've seen several transactions in the last couple of months. And again, these transactions have typically been tailored towards putting them on contract in the Middle East. The problem is that the price points are at least 30 to 40% different and pricing within the same week. Okay, so it's very tough to put an estimate of how much the pricing has gone up because it depends on the individual individual circumstances. So we had pricing at below 40 million for a rig. We've had pricing at $70 million for a rig as well. Okay. The only thing that we can say with certainty is that there is much more volume of transactions. There is much more buying interest than we have seen for quite some time.
And one thing, Shiv, you have very clearly stated or of the Q4 what happened, okay? But after March, there has been a lot of volatility in the rates, okay? And what we are seeing is smaller vessels have started doing much better, whether it is on crude side or product and even dry bulk. Do you think this smaller vessels doing better will continue for this year, or you think it will start getting reflected for larger ships also? So let's say cape sizes on the dry bulk and VLCCs on the offshore tanker side, and again so some thoughts on that.
Yeah, 1 minute. Let me check if Mr. Bharat Sheth has come back into the meeting.
Yeah, I'm on the call.
Yes.
Hello?
Yeah. Yes, sir. Could you answer that? He's asking about how do we see the performance of the smaller ships, the outperformance of the smaller ships in both dry bulk and tankers, and whether we see that continuing going forward.
So, clearly we don't know whether it will continue or not, but there clearly today is an outperformance across these asset classes. So let's take crude oil first. You have VLs, you have Suez, you have Afra. On the nominal supply side, the Afras have seen the least supply growth as compared to the VLs and as compared to the Suezmax tankers. That's number one. Number two, if you see some of the dislocation that has happened with the Russian oil being supplied into Europe, that's much more of an Afra trade. The VL trade is predominantly a trade emanating from the Middle East and West Africa, and that's not got impacted. So we have seen these spikes in the Afras, which we think, it give and take should remain relatively strong. Suezmaxes had, soon as the war began, there was a lot of immediate disruptions. The Suezmaxes benefited a lot in the first 15 to 30 days. It's now come off a bit, but it can spike again, easily and quickly. The VLs haven't really benefited yet from any of this disruption, but I can't see a situation on a sustained basis where you can have one or two of the sub-asset classes doing well and one particular asset class not doing well. So on a sustained basis, eventually there'll be some level of catch-up. Either all the three sectors will average better than last year or not. Our guess is that it will almost certainly average better than last year.
And even on the dry bulk side, the situation will pan in that way?
On the dry bulk, as you know, China has reduced its import of iron ore, which initially, for the first quarter, if you take the Jan-Feb-March data, China imported less iron ore and a little bit less of coal. That tended to impact the Capes. The Kamsarmaxes predominantly gained from the grain trade, which has been very robust. You've seen what has happened to food prices globally. And the smaller ships, the Supramaxes, the Handymaxes, the Handysize, they all benefit from a multitude of what we call minor bulks. Although, the sum total of all these minor bulks now exceeds a billion tons of cargo per annum. And that we have seen has benefited. There's a lot more export from Indonesia on coal. As you know, coal suddenly became a desired commodity for a lot of people. And recently we have seen the Capes do a quick catch-up because, suddenly, and a lot of you might have read it in the media, that India too wants to import an extra 15 to 17 million tons of coal. It's all going to come pretty quickly. And if it has to come quickly in this volume, really it has to come in Capes. So we've seen the Cape rates also just from March to now have, gone up 50, 60, 70%, depending on the day you take.
And one last thing, on the asset prices, we have seen the new building prices have increased very dramatically, and the crude prices have also increased. So the scrubber-fitted ships, are they getting any advantages? And is in the asset prices also, are we seeing there is a significant difference between eco and non-eco ships and scrubber-fitted, non-scrubber-fitted? And if we look at historical facts, do you think the market is fairly valued, expensive? So let's say 15, 20-year track record, all the three important categories for us. How are you looking at the market now? And how is it behaving?
Well, as I said in multiple calls, we never look at the market, right? Because we don't understand the market. So there's no point looking at something you don't understand. We just are price takers. We play the spot market, and we've seen that in bad markets, you obviously, like last year, we had a pretty tough tanker market, and you've seen where the earnings have been. And, now you are benefiting because you have everything spot. So these things all have a way of averaging out. And we will only short trade at elevated price points. Otherwise, we just take each day as it comes. As far as your question on the scrubber, etc., is concerned, the spreads, keep changing by the day. They peaked at about, so the least of the differentials was in the second half of 2020, where it dropped to some $30-40 a ton. It then widened to $100, then went on to $170, and now it's just shy of $100. So the spreads also keep changing. I think so. You've got now effectively a three-tier market. You've got one market for eco and scrubber. You've got one market for eco non-scrubber. You've got another market for scrubber non-eco, and then of course you've got a market for nothing, no scrubber, no eco. But eventually it doesn't matter because everything is on capital, right? So the capital that you pay for top tier ship is so much more than you pay for a ship which doesn't have any of these bells and whistles. And what we focus on is just return on capital.
Thank you, Mr. Upadhyay. Is your question answered? Thank you. We will move to our next question. That is from the line of Archan Pathak from Centra Advisors. Please go ahead.
Good afternoon, sir. Am I audible?
Yes, you are audible.
Yes.
Yes. I have been joining this call since past year, and I have to say your insights and views are always very interesting and helpful to listen to. So thank you for that. And my first question would be regarding the line item of profit and loss on sale of asset, which has been shown in the P&L. So has there been any sell-off in the offshore assets?
In the offshore side, we had a vessel which unfortunately, if you recollect last year, had a fire and came a total loss. So that asset has now been sold and delivered to a scrap buyer, and the vessel is now, as we speak, is at a scrap, at one of these beaches where scrapping takes place in Ireland.
Got it, sir. And secondly, the enabler cost for the issue of debentures normally used to range around 100 to 200 crores. But for this time, we have increased it to 1,000 crores. So any special reason for that?
No, we always did 1,000 crores.
What is that? Sorry, can you repeat that question? I can't, it's not very audible. Can you repeat that question for me, please?
No, I've got that.
Yeah.
Yes. Yeah, his question was the enabling resolution that we do for issue of debentures was usually 100 to 200 crores. This time it's 1,000 crores. Actually, that's wrong. Our enabling resolution was always 1,000 crores. We used to issue in tranches of 100 to 200 crores.
Okay, got it, sir. I might have got it wrong then. And lastly, I was going through our fleet details, and I noted that many of our tankers are, 2003, 2004 built, and very close to peaking out their life cycle. So just wanted to get your view over any sort of modernization plan. I looked at the asset pricing chart, and they are quite huge. The charts, the prices, they are at quite huge. We discussed even in the last quarter regarding that, with the lower freight rates, but the asset prices were hiking. And we talked about how there are chances that the tanker owners are waiting for price to, hike up to a level and utilize those price, then exit the market. So just wanted to get your view over how do you see that now with the rise in the tanker freight rates, which happened due to the recent war situation, there could be a slight off in the asset prices, and what about our modernization plan or any plan regarding increasing our fleet size? Thank you.
So asset values, as we've already, as the CFO said in one of the graphs, you've seen asset values continue to go up for the modern assets as well as for the older assets. Now, as far as our modernization program goes, we would love to modernize because we recognize that we have older tanker fleet than we would like. We are okay on dry bulk, and I guess we are okay on gas as well. But
Yes.
on the tanker fleet, we would like to bring that age, the average age of the tanker fleet, a few years younger than it currently is. But the price points are very elevated, and we just think that we are better off eventually, maybe not in the short term, but possibly in the medium to long term, just remaining disciplined and only modernizing the fleet, even at the cost of maybe losing some ships. We'll only modernize when we think the price points are right.
Got it, sir. Got it, sir. Thank you so much.
Thank you. The next question is from the line of Samraj N from Dwarka Share Brokers Private Limited. Please go ahead.
Yes, good afternoon, Mr. Sheth and Shiv.
Mr. Samraj, request you to use the handset.
Okay. You can't hear me?
There's an
Yeah.
echo, Samraj, from your line.
Hear me now?
If you're closer to any speaker device, Samraj, request you to please be a little away from there.
Okay, one minute. Hear me now?
There's still an echo. Okay, in the meanwhile, while we check your line, Samraj, we'll move to our next question. That is from the line of Faisal Hawa from HE Hawa and Company. Please go ahead.
Yeah. So what is our total debt, foreign debt as on date?
So basically, as you know, we have the bulk of our debt is being done through bond issuance. So, it starts with a rupee debt and a rupee liability, which then gets converted into dollars. So we swap the rupees into dollars on the currency, and consequently we get a benefit on the interest rate. And then we determine whether we are, effectively taking that into floating or swap. So I guess if your question is what is our total debt, our net debt is just over 700 crores. We are sitting on cash of approximately 3,000 crores. So I guess our gross debt is about 3,700 or 3,800 crores. Shiv, would that be right?
Yeah, you have cash of 3,000 crores and debt is only 700 crores. Huh?
No, that's net debt. Sorry, that's net debt.
Net debt
So
is 700 crores.
Debt minus cash is about 800 crores. Yes, is about a little over $100 million, 108 million.
Okay. So 180 means around 73, around 2,400 crores is what is.
Sorry. No, just hold on for a moment. What is that 2,400 crores?
No.
We have about $108 million of net debt. Yeah, that's a little over 800 crores.
Net debt is 800 crores and total debt is ex cash would be around 3,800 crores.
That is correct, yes.
Okay. So my question now is to Mr. Ravi Sheth. I mean, just some decades ago we used to be like.
I don't know if Ravi Sheth is on the line.
Okay, so no problem. So, we used to be a Sensex company. Not many, at least 2 or 3 decades ago, and almost a bellwether of the stock market. We have survived the last 2-3 decades. I mean, if you were to say only 3 factors, which have changed over the last 3 decades, and which have resulted in kind of a underperformance of the company, what would be those 3 factors which have changed over the last 3 decades on the industry as well as our company?
So I don't know exactly what the question is, but from the company perspective, I have no idea of Sensex. I don't follow it. I don't understand it.
No. I'll repeat my question.
As the company is concerned,
this has nothing to do with the Sensex.
What?
No, this has nothing to do with the Sensex. Hello? What I'm saying is that we used to be a bellwether company around 3.5 decades ago, and what within the industry and within the company has changed that now we are way beyond the mainstream companies of India. If you were to enumerate only 3 factors.
I don't understand valuation, I must admit, because you see these flavors change. And we went through a phase very recently where the greater the cash burn and the greater the losses, the better the valuation you got. And so the only thing we can do is to apologize to you for not producing a cash burn and for producing a profit as opposed to producing losses, because that's the thing that seems to catch fancy of people. Having said that, let me refer to the company itself. I think where the big change has come is, we were not very good at capital allocation, I guess about 10, 15 years ago. We significantly improved on it. And if you just break up the last 10 years into two lots of 5 years, our average return from 12 to 17, which was 7 to 8%, has now improved. Shiv, correct me if I'm wrong, but to somewhere around the 12 to 15%.
Yeah, close to 15.
From 17 to 22. So the company has, I believe, gotten much better on capital allocation, which I think will stand us in good stead for time to come. And that's the big one change. Values, as I said, I don't understand, because the superior the return, the greater the price on that.
In the latter part of your answer, I got the answer to my question. So basically, you mean to say that for a better part of the last 3 decades, we were not good capital allocators. Now that is constantly changing.
Yes, that's what I believe.
And what would be our ROC and ROE at the end of FY22 in year 21-22?
Our ROE, yeah. So I think it was a little ahead at 12% on reported numbers, and I guess on invested capital. So if you just strip out cash, which we keep for investment opportunities, I think we'll be closer to the high teens, maybe 19 to 20% on invested capital.
And sir, once you feel that this capacity utilization of 70% in the industry moves up to say 80, 82%, you feel a lot of pricing power could come into the hands of the shipping companies? And what is your sense of other shipping owners who are more?
Hang on, you're getting confused. So the 70% utilization is not in shipping. The slide that the CFO showed to you was the capacity utilization in the drilling business.
Okay.
And in the drilling business, which is now at around the 70%, I think as it crosses the 80% and moves closer to the 85%, the pricing power significantly changes from customer to service provider.
Okay. And that time may be quite near.
Well, that time will tell. I can't.
Yeah. I know. And sir, you feel that this entire deglobalization which is now happening could have a very big effect on shipping rates or shipping companies, because all the time we may be looking at some shortages in some country or the other, and the spot rates could always be higher.
So we have seen that eventually this deglobalization, whether it's going to work, not work, etc., it's too premature to say. Eventually, people will keep producing from countries which tend to have a lower cost base, be it in terms of capital or taxation or whatever it is, and there will be different sources of demand. That's as far as the consumer is concerned. Now, when you look at other commodities, like let's say a natural resource, right? I might suddenly say that I want, instead of India importing 100+ million barrels of oil, we should have our own 100+ million barrels of oil and stop importing. Now, that's not going to happen overnight, right? So on natural resources, the challenge is so much more than on the consuming side of the transportation business.
Thank you.
Hello.
Yeah, I'm done.
Yeah, thank you. The next question is from the line of Samraj N from Dwarka Share Brokers Private Limited. Please go ahead, Samraj.
Yes, thank you, Mr. Bharat and Mr. Shiv, for the question. If you could just take me on the spot current spot rates from the Suez right up till the this Balka Supras, I'll be really happy for needed for an Excel sheet. Excel. Thanks.
Yeah, but I'll tell you, I mean, I'm happy to give it to you, but a piece of advice is in shipping, there is nothing like current.
Got it. Because we have the FFA, I'm quite aware of it, Mr. Sheet.
Yeah. So the best is to be guided by FFA, and FFA changes daily. So just to give you an example, on the Cape side, the FFA between last week and this week is gone up.
Could you speak a little louder? Could you speak a little louder, sir?
Yeah. My volume is on maximum. Can you hear me now?
Yes, I can hear you very clearly now. Yes, I can hear you very clearly.
Great. So, yeah. Now, FFA is also, you should recognize, change as you know, every day. Right? And the liquidity in the tanker space in the FFA is not as good as the liquidity in the dry bulk space in the FFA. So, for dry bulk business, being guided by FFA is some basis on which you can prepare your Excel sheet. On the tankers, because of the lack of liquidity, it's a bit more challenging. And, this current, the only reason, I'm happy to give you any number you want. But
yeah, just as a guideline, so we won't hold it against you. If you could just give us the spot.
So as I said, so let me just complete. So as I said earlier, we are now in multiple asset classes because you have vessels which are eco scrubber fitted. You have another category which is eco non-scrubber. You have a third category which is scrubber non-eco, and you have a fourth category which is non-scrubber non-eco.
Right.
There are four. So the same ship, if it's in the top category, will have one earning, and if it's in the bottom category, will have a completely different earning. Right.
So we'll just take it for our ships. That is the non-eco, non-scrubber.
Yeah. So the bottom of the pile is the non-eco, non-scrubber. On the VLCCs in the spot market today, the earnings are negative $5,000 to $7,000 a day.
Correct.
On the Suezmaxes, currently they are positive between $5,000 and $10,000 a day, depending on where you are. On the Aframaxes, they are somewhere between $15,000 and $30,000 a day, depending on where you are. On the product tankers, the MRs are 20 to 30,000, the LR1s are 30 to 40, the LR2s are 40 to 50.
A little slow. I didn't get it from the MR. Could you take me from the MR onwards, sir?
Yeah. So on the MRs, again, everything is depending on, where you are and what position you are in, so on and so forth. I'm only giving you the bottom category, right? Non-eco, So the MRs have a range of 15 to 30.
Okay.
The LR1. Yeah, they're called the LR1, long range. Yeah, these are roughly 74,000 deadweight, 70,000 deadweight. So it's like the Panamax.
Right.
For the product business. So they vary between 30 and 40.
Okay.
And the LR2s are varying between 40 and 50.
40 and 50. Okay. So that leaves us just with the Kamsars and Supras, if you please.
Yeah. So the Kamsars currently are again varying between, you can say, 20 and 30.
Okay.
And the Supras are in a similar range, 20 to 30.
Right. Okay. So thanks so much for this guideline, sir. I just wanted to ask you, are we? I understand that you have back tested your model for capex and all this, but are we being very ultra cautious? Because if you see the recent, of course, these people were in big trouble before the rates went up. I'm talking about Scorpio. And they sold off their almost the entire, I think, the entire LR1 to Hafnia, and Hafnia purchased it in one stroke, and of course now they have done a lease back to manage their balance sheet. But I think day before yesterday, Navios has gone in for 4 product, and that also new builds. That is, I'm talking about the product tankers. 4, I think LR2 she's gone in for.
They have gone in for LR2s.
Correct.
Against a long-term charter.
Correct. I got it.
But that is not the business model we follow. We don't like to do 8 and 10-year charter transactions.
But sir,
our preference is to play. Hello?
Agree. Your whole model today rests on being more on the spot now.
Spot market and playing the volatility the best we can. Sometimes it works in your favor and sometimes it works against you. So it's a very different business model. Right? Now, on the question of whether we are being overly conservative, I mean, my view is, look, in a rising market, one will always feel, were we being too conservative? Because, when you have a rising market at every price point, you can make money. What we have learned in the past, and it's a mistake we would not like to be repeated, is that long term, and I repeat the word long term, which means, in the life, and a life, who knows what the life of the organization will be. I truly believe that we will be much better served, and so will our investors be better served, if we are much more disciplined on capital allocation.
Got right.
In the short term, it may be painful.
Just being the devil's advocate again, you see, I'll totally agree with you when you're talking about the container liner part of the market, because there the order book is now closing at almost 33%, and there was really a panic buying over there. So I'll leave that out. But if you just see the product side of it, that I'm talking about the MRs and the LRs, there the cost advantage, the yield, the freight yields on the capital investment of the ship works absolutely in our favor right now. So why can't we consider product tankers? And going by the current logistics, because of the current logistics and the Ukraine, etc., and refineries shutting down and opening up elsewhere, at least on the product side, we can consider purchasing a few. That would be my humble observation.
No, it's a very valid observation, and I'll tell you where the trap lies. It's a debt trap. No business I have come across is sustainable at, these kind of current deals, right? Okay. Now, what are the mistakes? One of the mistakes we made in the past is, because we got tempted with very strong current deals, which were 40-50% on capital, it was obviously there's a temptation that we should invest in steel, which has a current yield of 40%. Why keep money in the bank, when you're running 1 and 2%, right? That's basically the logic. Now, this was the exact trap that a lot of people fell into when Lehman happened, right? Or even when the virus hit the world, right? So at the time of the pandemic, you think what the product tanks were doing before Russia decided to invade the Ukraine. These product tankers were earning $8,000 and $9,000 a day.
Correct.
Right? Now, the great trap is when you get tempted when yields are this strong. This is actually when yields are at, you should be selling a 40% yield asset, not buying a 40% yield asset. Because it's not sustainable.
Okay.
Which business is going to allow you a 2-year payback on a sustained basis?
So even at these, I would say that LR1s at 30 to 40 and 40 to 50 is really not that off the mean, because we've gone to a very low patch. That is why we are thinking in these terms that
No.
they are
That
on
is
the higher.
no. It is significantly higher than the median.
So what would be the mean according to your model, sir?
About 18.
18. Okay, I see. Okay, now I get your point. Okay, fine.
Yeah.
Okay.
Okay.
Right. But
Thank you.
sir, just last question, Mr. Bharat. Even going by some of the models which are getting simulated from the year 2 and to the end of this particular calendar year, right up till 2025-26, they are saying the supply and demand of vessels in almost all categories except containers would be very, very favorable for owners. So I was just still wondering whether we should hold keep up to the 18 mark, or raise the mean a little bit up, say 25, 30, something like that, to consider purchasing.
We can raise it to we can raise it to anything you suggest. But by me raising it is not going to change things, right? We have seen what you need. Yes, a nominal supply clearly helps the market. But also, think of what happened. The nominal supply was as nominal when the COVID hit the world and when demand got destroyed. Now think today, if you see the Jan to April data, China, which is one of the big players on energy imports, their demand is lower. And, if you get another wave or some other thing, we are living in very, very uncertain geopolitical times. So, it's, I can raise it to anything I like, but that's not going to help. So, all we are saying is, yes, in a rising market, you will get penalized for being overly conservative, and that's why we keep our operating fleets in the spot market, you see. So, we at least significantly benefit in the spot market. But I know that only we will be left belling the cat if we bought expensive assets and there was a unforeseen event which then brought markets down. So we don't want to fall into that trap again.
Yeah, just to clarify that 18,000 is not our number. It is the history. It is not some number that we have put as our cutoff or anything. It is the actual history of the market that we are talking about. So we have no role in increasing it to any.
We have nothing to do with this. So we can put any number we like. But look, I'm saying I don't know what the market will be on a Monday morning. If I had a ship to fix today, and if I have a ship to fix on Monday morning, I honestly cannot tell you what rate I'll fix it on Monday. So what is the use of taking any median? And here I've just taken out the precise number is 17,000 on the LR1.
Thank you.
Hello.
Yes, sir. Thank you. The next question is on the line of Samrat Singh from TPF Capital. Please go ahead.
Hi, am I audible?
Yes, Samrat.
Yes,
please go ahead.
Yeah, thank you for the opportunity. I just have two questions. My first question was, is there any opportunity to purchase assets from any Russian shipping companies who are looking to sell at a discount or in distress?
So, number one, we would have to look at whether any of the Russian entities we deal with, are they sanctioned, not sanctioned. If they're sanctioned, the answer is no, whatever be the price. And if the entity is not sanctioned, it is something that we could consider. But we've got to be very, very careful because we've got to go through multiple layers of corporate veil to ensure that the end beneficiary is not sanctioned also. So it's not an easy exercise.
Okay, I was referring to, I think there was news of Softcom Float, undergoing a massive tanker sale and,
Yeah, we are aware. We are aware of that.
So is that something that we would be looking at or no?
No. So again, as I said, there are multiple entities involved, and we would have to get a sign off from multiple layers of legal checks and balances before we can answer that question. Because, every day is a moving target. And every day there are new entities getting sanctioned or not sanctioned.
Right. Okay. And just one, a question on capital allocation. I'm just trying to understand this buyback that we are currently going through. Is it fair to say that we will continue to repurchase the shares as long as the discount to NAV continues, up till whatever, I guess until the 75% promoter shareholding limit? Is that a fair assumption?
No. So, we only look at what is the discount to NAV and at what price point is your NAV. Okay? Now, when we announced the price, which was 333, we believed that the discount to the NAV was excessive, and hence we announced a price of 333. If you ask me, of course, today we can't buy because we've crossed that discount to NAV. Although our NAV has gone up, the share price has gone up, so we can't buy. The point is, the NAV value of the business also changes every quarter, every 6 months, every year. And we will keep looking at what is the discount to NAV. And, ideally, your best allocation is if the shipping market is saying steel is worth $1, but the paper market, which is represented by investors, is saying that we think the steel is worth 50 cents on the dollar and not $1, why would we want to pay $1? You are better served buying paper at 50 cents, right? Or 60 cents.
Right. So my question was...
I think earlier people said, why don't you buy a ship? But if I buy a ship for $1, the investors are saying it's not worth $1. It's worth 60 cents. So how can the same investor say buy a ship?
Right. No, I agree. I guess my question was 1 year from now, if the NAV, if the discount to NAV is excessive again, would you institute another buyback?
Yeah, so it will depend on, our window will only open a year from now, or a year from 2 months from now, so 14 months from now. And we will look at what is the need. So our priority will always be to buy steel. Okay? Buying paper is second priority to buying steel. So let's say my paper is cheap, my steel is cheap. My preference would be to buy steel. But if my steel is expensive, but my paper remains cheap, and I have surplus capital, then I'll buy paper.
Makes sense. Thank you.
Yeah.
Thank you. The next question is from the line of Vaibhav Bajatya from Honesty and Integrity Investments. Please go ahead.
Yeah. Can you hear me?
Yes,
yes.
you can.
Yeah. Thanks for providing the opportunity. So just one question. Whatever has happened on Russia and Ukraine, in that terms, if we take the situation pre-war, whatever was the crude and the refined products exports from Russia, if we were to assume that that all these products will get redirected to say China and India instead of Europe, then what would be the demand side impact due to the increase in ton miles first? And second, on the supply side, if um, uh, so, so how much is the Russian supply, Russian supply of ships? Is what I wanted to understand. So I just wanted to understand both the demand and supply side impact, so that we can make a judgment as to what is going to happen over long term.
So it's, I think all that we can say is that if what Europe is importing currently from Russia is imported from areas which are further away, like for example the Persian Gulf, or from China, non-pipeline from China, etc. That's, obviously that supports the market and it adds to ton mile. The question also is that that particular product has got to be in surplus, because if somebody wants product A and that product A is not available in the market, then that demand remains unsatisfied until somebody can supply the product A. So it's not, it's something that has to be dynamically looked at and managed, and that's, what we are doing in order to try and play the spot market and determine what we think, is to happen today and tomorrow, and do we fix a ship today, do we fix it tomorrow, etc. But it's, again,
I was not talking from the bulk market perspective. I was just talking from the energy market perspective in terms of crude and product.
I'm also talking about energy market. I'm talking about the energy market. So, I look at petroleum products, I look at crude oil, I look at gas, all the energy-related markets. Coal is an energy-related market. Looking at all these commodities, everything will hinge on where is the surplus capacity, from where can it be sourced.
Right. So
and that is
actually,
that's
actually the one part of the equation, in the sense that how Europe is going to alternatively source it, but that will have incremental demand impact. But what I was asking was another part of the impact, that Russian supply, to some extent it will be reduced, but it will be available, and if it gets due to geopolitical reasons, if it get diverted towards China and India, then what would be the ton mile impact? Because that supply is in front of us right now. That will be available, maybe 10-20% down.
What will be available? You mean the Russian ship?
Russian supply of crude oil and whatever refined oil or refined product that they use.
So the Russian supply of crude oil into China, there is a pipeline which has been laid multiple years ago. So a lot of the import from Russia into China is happening on the pipeline. Of course, there is also a trade from Russia to China on ships. Some of it is carried on Chinese ships, some of it is carried on Russian ships, and some of it is carried on third-party ships. So that trade at the moment, but some of that trade is short haul. So if you take, there's a Russian port in the Pacific called Kozmino, and Kozmino to China is a very short haul trade. So again, it depends. Is it the Baltic? Is it the Black Sea? Is it Asia Pacific? None of these things are easy to answer. I mean, unless one truly gets deep into the business, it's difficult to answer and even more difficult to understand.
Got it. Understand. I think.
But we are only focusing on energy. You've got to think of the grain market as well, because between Russia and the Ukraine, I think they were approximately 30% of the grain market. And can that easily be sourced from other grain growing areas? I don't know. These are very, very difficult questions to answer.
Right. Right. Yeah. That's what my assessment was, that the supply would be there with Russia, because then there's no alternate. So I think it would be just the redistribution of the who is supplying to who, rather than Russia supply going off the market completely, because practically it's just not feasible. And that's why I just wanted to understand the impact on the ton. But I understand it's too much uncertain as of now, so we can't kind of quantify it. That's it from my side. I think that's the only question that I have.
Thank you. Our next question is in the line of Amit Khetan from Laburnum Capital. Please go ahead.
Hi, good evening. Thank you for the opportunity. Sir, in one of your earlier calls, I believe you had indicated that you expect product tankers to lead the recovery. And if you look at what has happened over the last couple of months, there seems to be a significant improvement there. So, in your opinion, has the cycle finally turned, or is this a short-term phenomenon?
Again, I would hate to really stick my neck out on this, because these, again, one thing we must all understand, whether it's on this call or any subsequent call, that these markets are determined by events. And there are certain events that have a bigger impact. There are certain events that have a less bigger impact. Now, the longer the disruption that takes place of cargoes moving into Europe and other destinations that hitherto went from Russia, if there is a lot of disruption there and there is cargo movement, then logically you should get the strength in the market continuing. Having said that, we are also hearing, right, this word called stagflation, and whether, the demand for certain commodities is just going to get reduced because of inflationary pressures that the consumer is feeling, or, whether the inflationary pressures means there are some places where the demand will reduce. You're also getting issues like China, where, lots of cities are in complete lockdown. The demand for oil has come off. And these are important consumers of energy. So there are so many moving parts that are playing simultaneously that it becomes extremely, extremely difficult to say that, this is going to be sustained or not sustained, a rally. I just don't know, and I want to be honest about it.
Thank you. Our next question is from the line of Samraj N from Dwarka Share Brokers. Please go ahead. Samraj, your line is unmuted. Request you to please unmute yourself and proceed. It seems there is no response from the line of Samraj. We will move to our next question, that is from the line of Himanshu Upadhyay from O3 Capital. Please go ahead.
Yeah, I had one question. When you replied that the market has become multi-tiered, so eco, non-eco, and scrubber, non-scrubber, the combination, how different are the rates between the base, which is non-eco, non-scrubber, and the eco and which scrubber ship you are able to get? And again, the asset prices, how different are they, even within one class? Are the asset prices significantly different, and the rates also significantly different? And are people ready to pay for more, less polluting ships more, some 2-3% or 4% higher? Or
No,
ship
the
versus
market is not.
ship, something like
that. Yeah. See, the rate is the same. What happens is, when, suppose I have a vessel that is eco and a colleague of mine has a vessel that is non-eco, on the same rate, my eco ship makes me more money than my colleague ship, which is non-eco, right? Having said that, you've got to remember that as far as the customer is concerned, he's paying you an X dollars per ton, right? So he is not necessarily going to pay you unless now when you convert all that into time charter rates. So first I'm discussing just simple voyage calculations. Then when you go into time charter, obviously the customer does the same calculation as you, saying, look, if I take in a vessel on time charter and I've got an eco ship, this is what I burn in terms of fuel, and so I don't mind paying $2,000 a day more. But remember that that asset is also that much more in capital, right? So at the end of the calculations, it is, whether eco scrubber-fitted ship produces a superior return to capital to a vessel that is non-eco, non-scrubber depends on a multitude of factors, and not just eco and scrubber. It depends where the ship, if you're playing ships in the spot market. Now, obviously, the better the ship in terms of eco and scrubber, the easier it is to market. Especially if you want to fix her for 2 years or 3 years or 5 years. As many owners like to do. But that's not the game we play. In the spot market, it doesn't make much of a difference.
Okay. And is the difference similar between single hull and double hull? It was like in early 2000s? And
No, it varies. There's no standard differential, because today, say the scrubber differential, I think I said it to one of the earlier speakers, that differential now is down to $85. It was $100 a few weeks ago. Prior to that, it was it peaked at $180 in the immediate cycle. In 2020, it was down to only $30. So that is also changing all the time. The eco is a lot more constant, but the scrubber benefit varies depending on the differential. And these differentials, like any other commodity, are changing all the time.
So the asset prices are also very volatile between let's say a scrubber ship versus an eco?
Asset prices are volatile per se. Now, some people will prefer a scrubber ship. Some people may not prefer a scrubber ship. So if you take, for example, I'll give you a simple example. Take the Indian PSUs, right? They say, we will not pay you any premium for the scrubber. So if I have a scrubber ship, and if I put it into an Indian trade, am I going to make any money from the fact that I have a scrubber? Answer is no, I will not.
Hello. Thank you. We have the next question from the line of Samraj N. Please go ahead.
Yes. Can you hear me, sir?
Yes.
Yes.
Okay. So, Mr. Bharat, I just wanted to ask you whether our management subscribes to the super cycle model, say between end of calendar year 22 right up till say 26, 27, because of the reasons of EEXI, CII, and the yard slots not there, no one knowing which is going to be the new design as far as fuel and propulsion is concerned. So do you expect a squeeze in those years, and then what probably could be the your hypotheses on the freight rates?
I've said often enough, I have no hypotheses on the freight rate, and I don't know what will be the impact of EEXI, CII, new types of fuel. I just don't know. So I don't want to fabricate something when I don't know.
Okay.
All we can tell you is that there is going to be a lot of upheaval. There's going to be a lot of uncertainty. And traditionally, whenever there has been upheaval and there has been uncertainty, it has tended to benefit ship owners.
Okay, great. And that would be the ideal condition for you, because you will be getting a volatility there.
Well, nothing is ideal or not ideal. As I've said I think maybe 5, 6, 8 quarters ago, a bad market is good for us as well. A good market is also good for us. So we are positioned where we can benefit from a bad market, hopefully by getting cheaper assets to expand. We benefit from a good market because we build up more cash because of the operating leverage. We run a very high operating leverage. We are very conservatively leveraged on the balance sheet. We are highly leveraged on revenue.
Thank you. Our next question is from the line of Amit Khetan from Laburnum Capital. Please go ahead.
So thank you for the follow-up. We were operating largely on the spot market on the tanker side. Have we increased our time charter exposure over the last couple of months, or have time charter rates not moved as much as the spot rates?
The time charter, so we have increased it marginally. Out of 17 product tankers, for example, we have time chartered out, let's say for the next 6 to 9 months, a little over 2 ships. Right?
Yeah.
Out of the 17 that we operate in the spot market. So, if the answer is, have you time chartered out? Answer is yes, we have. At, of course, numbers that were meaningfully higher than the average of last year. Will we time charter out more? It will again vary on what the rates we get are. So we are always assessing it. And we would not like to, time charter out everything, nor would we, in bad markets, we are happy to run everything spot, but in strong markets, I don't think we are happy to charter everything out.
Got it. And lastly, if you could provide some commentary in terms of, how has your strategy changed for the different segments as a result of the war? Are you, you would have done some situation or scenario analysis. So any, what's your sense of how, it's going to impact the industry and if there has been any change at your end in terms of how you are thinking of the different segments?
No, we are not. We are not thinking at all of changing our strategy, which has played out pretty well, let's say over the last 5 to 7 years, 6 years. So if something is playing out well, you might as well stick to it.
Sure. Got it. Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Ms. Anjali Kumar for closing comments. Thank you, and over to you, ma'am.
Thank you very much. And this was a rather engaging discussion we had today. So thank you to everybody who participated. And as usual, the transcript and the audio link of this call will be up on our website in the next couple of days. And also, please feel free to reach out to our team at any time that you like. Thank you so much, everybody.
Thank you very much. Thank you. Ladies and gentlemen, on behalf of the Great Eastern Shipping Company Limited, that concludes today's call. Thank you all for joining us, and you may now disconnect your line.